Every month, a middle-class American family pays their mortgage. Most of that payment goes to interest, not principal, interest. On a $500,000 loan at 7%, over 30 years, you pay just under $700,000 in interest, about $697,500. That's not a typo. You repay the loan, you repay it again, and then some. And here's the part almost no one talks about. The shape of that interest bill isn't fixed by law or by economics. It's a design choice. Someone a long time ago decided this is how it works, and that's it. For most of the 20th century, a 30-year fixed mortgage was considered the responsible choice. Predictable, safe, but that predictability has a hidden shape to it. Because of how amortization works, the early years of a 30-year fixed, almost every dollar you send in goes to interest. In year one, on a $500,000 loan at 7%, you'll write about $39,900 in payments, and only about $5,100 of that actually reduces your balance, roughly 13 cents on the dollar, and it stays that way for a long time. It takes more than 20 years or 2/3 of the life of the loan before you're finally paying more principal than interest in a given month. That's the shape you inherit when you sign a 30-year fixed. It's not evil, it's just the design. The Wealth Builder HELOC replaces that design with something structurally different. Instead of a fixed mortgage on one side and a checking account on the other, it combines them into a single open-ended line of credit in first lien position on your home. Your paycheck lands in this account overnight. Interest is calculated the next morning on whatever you actually owe that day, not on some fixed monthly formula. Just today's balance times the annual rate divided by 365. If your balance is $500,000 and your rate is 7.65%, tonight's interest is $104.79. If your balance drops to $480,000 tomorrow, tomorrow's interest is $100.60. Every dollar you deposit reduces the balance the interest is calculated against the moment it arrives. Every dollar you spend adds back to it. Your balance is a living number now, not a monthly snapshot. Your paycheck, let's call it $11,000, lands in the account on the first. The balance drops from $500,000 to $489 overnight. Tonight's interest goes from $104.79 to $102.49, and it stays lower every night after that. For 14 days, you don't touch it. Around mid-month, your bills hit. Car, credit cards, taxes, insurance, necessities. Call it about $5,200 flowing back out for everything except the mortgage. Because on this structure, the mortgage isn't a separate thing anymore. The deposit sitting against the line is the payment. So $11,000 in, $5,200 out. And the line charged you about $3,150 of interest over those 30 days. Net result, the end of the month, your balance is about $2,650 lower than where it started. Now let me be straight with you about something, because this is where these products usually get oversold. In month one, this line actually costs you more interest than the fixed loan would have, about $3,150 against roughly $2,920, because the rate on it is higher. The advantage isn't the rate, and it never was. The advantage is the balance starts falling on day one and never stops. Run that 12 times. Year one, you take about $32,500 off the loan, balance around $467,500. And because the balance is lower, year two takes off more than year one did. That's the part that compounds. You didn't change your paycheck. You didn't change your spending. You just changed where your money lived while it was waiting to be spent. Same borrower, same paycheck, same spending. Two loans. On a 30-year fixed at 7%, the total interest bill is about $697,500 over the full 30 years. On the Wealth Builder at 7.65%, given that same $11,000 monthly deposit and $5,200 a monthly spending, the same borrower would be projected to pay the balance off in about 10 and a half years, with total interest closer to $228,000. That's a gap of roughly $470,000. Same paycheck, same spending, just different architecture. But slow down with me. That projection is based on the borrower actually maintaining the discipline of the account. Every one of those numbers assumes a full $5,800 of leftover cash flow stays against the line month after month for a decade. If someone takes the line and just spends up to the limit, the math falls apart quickly. This product rewards behavior. 3 gates you have to clear for this to work. Number one, positive monthly cash flow. Number two, discipline about not spending up to the line limit. And number three, comfort with a variable rate that adjusts monthly. The rate is the 30-day SOFR plus margin. That's the secure overnight funding rate. Currently, rates are about 6.375 to 7.625% depending on your specific profile. It moves. If a rising rate would keep you up at night, this product will not be your friend. The Wealth Builder is not a magic product. There's no leverage, no arbitrage, no trick. The math works because traditional mortgages force your paycheck to sit somewhere else, earning almost nothing while interest accrues against your loan balance. When you fix that inefficiency, you save a lot of interest. If you think you might fit, let's have a chat. Not to be sold to, they have someone and run these numbers against your specific paycheck, your specific spending, your specific situation. And if the math works, great. If it doesn't, I'll be the first to tell you. I'm Todd Hanley, a senior loan officer and mortgage broker with United Direct Lending. If you'd like a transparent, data-driven process that removes the guesswork, I'd love to speak with you today. Thanks for watching.